Hello everyone and welcome to This Week in the Markets. Last week there weren't any major events that moved the market as such, but there were a few interesting news, most of which seems to concern Spain, and we think that developments there could potentially have an effect on the market. So we'll spend a bit of time discussing that as well as some data released in US, and we'll do that right after our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So over the weekend, there was much speculation that Spain could be ready for a bailout as soon as this coming weekend, according to an apparent leak by senior officials of the Eurozone as reported by Reuters. Although such hopes were dismissed by Spain's Prime Minister Mariano Rajoy, who said for sure that Spain would not be applying for a bailout this weekend. But it leaves the market pondering that if not now, maybe soon. Already though, it seems like Spain is paving the path to apply for a bailout as it announced a savings of 13 billion euros in its 2013 budget. This budget has many similarities to the austerity measure imposed on Ireland when the government applied for a bailout, and also the Spain's creation of an independent agency for budget monitoring also sounds like a request from the European Union as well. So it seems like the Spanish government wants to make sure that the application for bailout runs as smoothly as possible by already preparing beforehand their own austerity measure. So what would this mean for the market? Well, for one, if Spain does apply for a sovereign bailout, it would likely restore some stability back to the market. Also, it will qualify it for the Mario Draghi's unlimited bond purchase program. So just like in the US where we have the Bernanke put, there will be a Draghi put on Spanish bond, and that would cap the yields there, and that would be quite attractive for bond traders. In the short term, this could strengthen the euro as money returns to Europe for investments, but for the longer term, the bond purchases could have an inflationary impact on the market, especially if the number of countries applying for bailout increases. So this could cap the upside for the euro. Also, this could also have a negative impact on US Treasuries as there would be lesser demand for safe haven in US Treasuries as investors could start selling the holdings of US Treasuries and pursue higher yields in European bonds, given the Draghi put effect. So far, long-dated US Treasuries have recovered all the losses since the announcement of the ECB's bond purchase plans and the Fed's QE3 announcement. We find this to be quite puzzling because other indicators like gold, which seems to be rated for another leg up, and also the 10-year break-even, which both suggest the inflation remains a genuine concern for traders. We think the only reason why long-dated treasuries still drew in such high demand is because the uncertainty over the Spanish bailout and because investor sentiments are still quite low in US, and so they are unwilling to switch their holdings out of US treasuries into equities, which are still currently trading near the 4-year high. Nonetheless, taking a medium to long-term perspective, we're still bearish on long-dated US Treasuries given the ECB and Fed stimulus actions. And in US, the ADP employment change report, which was released yesterday, suggests that 162,000 private sector jobs were created in US last month. This was almost 20,000 jobs more than expected, and is the 4th consecutive month where actual figures were more than consensus. This is actually in quite a stark contrast to the non-farm payroll, which had been falling below expectation for the last few months. If we compare the chart of the ADP report and the non-farm payroll, we see that both charts has quite a tight integration, which put simply means that the chart tends to crisscross each other quite often. The ADP report has been overstating employment for quite a few months now, or the non-farm payroll understating, we do not know which one yet. But it could be something for us to look forward to when the non-farm payroll is released on Friday, to see whether it will play a catch-up effect. The Institute of Supply Management also reported its non-manufacturing PMI yesterday. This index, which tracks the service sector in US, recorded a reading of 55.1 in September. This is way above the expectation of 53.2. And like the manufacturing PMI, above 50 on this index means that the sector is expanding, while below 50 means that it is contracting. So basically, this index shows that the service sector had been in expansion since 2010, And although there was some fear that the US economy had been slowing down since March, and the recent uptick though suggests that there is a resurgence of non-manufacturing activities in US, and that should also be beneficial for the jobs market there. Well, that's all from us this week. In the coming week, the single biggest source of volatility will probably be the release of the non-farm payroll report, which will be tomorrow night. Equities tend to consolidate before this report and break out after the release, especially if it is a lot better or worse than expected. So we'll be keeping an eye on that. And we'll also be keeping a close watch on clues of potential Spanish bailout, as it is likely to have a significant impact on the market as we mentioned earlier. So there'll be another update for you next week. Until then, on behalf of the Trading Pursuits team, we wish you all profitable trading.